Well, hello, Solis Wealth Management family. My name is Luis Carrera. I'm a wealth advisor here at Solis Wealth Management in La Quinta, California. Nice to see you again. Thank you for tuning in today and for spending the next few minutes with me. Now, today I want to talk to you about the current economic environment and some of our views on the prospects of the equity markets. And I want to start by talking about the current interest rate hiking cycle that the Federal Reserve started to implement at the beginning of 2022. If you take a look at the Fed funds rate today, the interest rate that the Federal Reserve has been increasing to bring down those inflationary pressures, well, that rate is now sitting at a higher level than that of the long-term inflation metric, the CPI or Consumer Price Index. And that is significant because combined with other factors such as the tightening of the credit markets, some recent banking sector issues, of course, we have some recent weakness in corporate earnings, and of course, geopolitical risk and domestic policy risk, all of those factors continue to increase the likelihood that a recession might develop sometime in the latter part of 2023. Many analysts and industry observers think that a recession is all but inevitable. Our base case here at Solis Wealth Management has not changed, and we think we're going to develop into either a soft landing or a mild recession. But we continue to be vigilant and cautious about how we navigate this environment. Now, one of the consequences of the implementation of that unprecedented interest rate hiking cycle by the Fed is that it has not only affected the prices of equities and bonds, but it has also had an effect on short-term investment instruments. And we are now seeing yields that we haven't seen in many years. And we, in fact, have observed outflows going out of equities and bonds gone to the sidelines to be invested in these short-term investment instruments such as money market funds. Now, this is part of the reason for our optimism. We know that eventually, at some point, all of those assets are going to flow back into the markets. And there is an estimated $5.5 trillion of assets sitting on those sidelines. Now, this is part of the reason why we take a historical perspective as well, and again, part of our optimism. If you take a look at the last 35 years of Federal Reserve interest rate hiking cycles, you will note that after each one of those hiking cycles, the preceding 1, 3, and 5-year periods saw equity returns significantly outperform the returns of those short-term investment instruments. And here again, part of the reason why we rely on strong fundamental financial planning analysis and a disciplined investment approach. Well, very well. If you have any questions, please don't hesitate to reach out to us. Let us know how we can help. The team is always at the ready. Send us an email, give us a call. But until next time, so long, everyone.